Morning, Nath.
Morning.
It's fast approaching the end of financial year. Obviously, we're always passionate about helping our clients and how can we add value. So this time of year, what should our clients and people watching this video be focusing on?
I think there's things to focus on and there's things not to focus on. And so we're getting questions around super contributions, which are really important to consider. And also, questions about, I'm seeing this ad on Officeworks and it's saying, come buy computers, you may get a tax deduction. I mean, if you need a computer, maybe.
It's a common misconception and it's an easy trap for people to fall into to make a purchase in order to create a tax deduction where potentially might have been better just to keep their money in their wallet.
Yeah, it's either 55 cents in the dollar or 45 cents in the dollar at the top tax rate.
Can we delve a little bit more into the superannuation contributions piece and how it can be of benefit to people?
At the moment, this financial year, you can put in $27,500, including what your employer already put in. But a few years ago, they introduced what we call our carryover rules. And so if you have a starting balance at the start of the financial year of under 500,000, you can actually go back to 2018-19. If you didn't contribute during that time, if you were off work, if you were part-time, you can put in up to 25, 25, 25, 27.5 in total. And this will be the first year we lose a year because it does it over rolling 5-year periods.
Okay.
So the 2018-19 year will disappear. I've been talking to quite a few clients about this, particularly if, say, they've sold some investments, or for example, a property. And let's say they usually earn around 120,000 and they've sold for a gain and they're up in the 250 after that capital gains. What we would try and do then is mitigate that tax down to a reasonable level. So making a lump sum contribution, let's say we put in another 50,000, so you're not paying tax on that 50,000, which works out around 25 grand.
In rough terms, what's the percentage benefit to a client, say on the highest marginal tax bracket?
When money goes into super, it's taxed at 15%, unless you're over 200,000, in which case they whack you again, which makes it 30%. So the smallest benefit you could get in this circumstance is about 15% plus Medicare.
Something else that I look at personally in this tax space as well is every dollar saved on the expense line is basically $2 that you don't have to earn. I know I had a recent experience in terms of car insurance where I'm now saving $650 a year just by shopping around, and it literally took me about 5 to 7 minutes.
Reviewing the marketplace and seeing what else is available is definitely an important consideration inside of that.
Apathy is the enemy, isn't it?
Absolutely.
Apathy is the enemy.
Right now, I think we're seeing quite a bit of stress around expenses. And I think one of the best things you can do is actually understand where your money is going.
This is this term that we use with our clients too, isn't it, around conscious spending?
Correct.
So structure creates freedom.
Because if you know, you've got less chance of being fearful. If you're being hit every day with the media telling you that it's getting more expensive, but how much and what's impacting you, you can then make better decisions to both feel that sense of security, but also, I can spend some money and have some freedom of choice as well.
Coming into the end of financial year, a lot of people will be up for salary and REM reviews come July. What's the best way for people to tackle that?
Especially at the moment where we've got a situation of 7% increase in CPI, which means that if you don't have a pay rise of 7%, you lost 7% of your earnings. We work with a number of people who specialize in sitting down with you and knowing your worth so that you can have those conversations with your employer. And sometimes they've got their own pressures, they're not paying attention.
A couple of suggestions from myself would be, looking at Seek, so comparable roles. Really, investing an hour in going back and having a look at your job description and the value that you've added in that role or that business over the last 12 months. It's not about moving around employers, but it is about understanding your worth, isn't it?
Absolutely. And then the other part to that is sometimes being a bit patient. If you've got a situation where you've got high childcare costs or high school fees right now, and you may not be saving or building a lot of surplus income into your investments right now, but you're able to do the things you want to do for the most part.
Yeah.
To say, okay, in 3 years' time, we drop off those school fees so we can be patient because sometimes there's not levers we can pull right now.
We often see financial freedom and success and security for our clients is done over a medium to longer term. It's patience, it's consistency, and it's forming the right habits. And it's not all about delayed gratification either. There's got to be some fun today and tomorrow as well.
Got to have enough of the things you enjoy doing to create patience so that you can act when it's appropriate and not be forced to move.